Well, hello, everybody. Welcome back to the Enlightened Investor. We've got a lot going on here. We just heard from Mr. Producer Ryan that his Ameren, Illinois bill is up 90% last month. So what does this mean?
I think we're going to talk about inflation.
So one thing that's not going to be inflated is our hats.
Our hats from our producer.
Thank you.
Yes.
How many is made, Ryan? 3 of them. So we know
not available in the store yet, right?
Not available in our store, but we know that with just 3, that's not going to be inflation.
Right.
Well, folks, we're going to have a little talk about inflation. It's all the issue of the whole year 2022. We're going to talk about what does it mean, and also like some of the errors maybe the Fed has done, as well as to kind of talk about the investment strategies going forward. But the first thing is I'll tell you what, more and more people I run into think they can use technical analysis, think they can use like past performance to forecast indicators. Let's talk a little bit about the Super Bowl, Mike. So,
okay.
Super Bowl indicator, right? So, what do we know about like? Can people correctly pick the winner of the Super Bowl easier than stock market's going up?
No,
yeah.
Right? Exactly. The bookies are normally pretty good at it. Once they get the spread, what do they call it? The VIG.
The VIG.
The VIG.
Yes. Yeah. So I will tell you something interesting. I'm not sure if the last time you're our big reader here. The Random Walk Down Wall Street, in there, Burton Malkiel has what's called a Super Bowl index. And get this, folks, it's a randomness, but 80% of the time, if an AFC team wins, and this year it'd be the Bengals, if they win, the stock market goes down. And so we're rooting for the NFC team this year, which is the Rams. Now, that's just random, right? That's just random.
Yeah.
But people are, betting on DraftKings that this is going to happen.
That the Rams are going to win?
Well, or just, yeah.
Well, I gave you that article I sent you in the email as well that said we're going to, I forget, they showed the alpha. The alpha was for the Bengals, but because of regression to the mean, they thought that the Rams were going to win. So
I get it.
There goes the market.
Well, guys, if you know Mike Mahoney, you definitely run into someone that's going to send you some material, right?
No, I just sent it to you.
Okay, I feel better about that.
Well, and the producer. You
producer?
guys get all my.
I feel so special.
I spare my clients. I'm down to about only maybe 1 or 2 emails a month.
Yeah, great.
Yeah, we cut the material down.
Awesome.
We
folks,
do it out here on YouTube now.
Yeah, so I want to show you another thing that's kind of fun. Like, we just can't.
Okay,
we have to self-promote a little bit. So
if I'd have known you were going to share this, I maybe would have posed or something.
This is such a great picture. This is Mike Mahoney coming back from like a red eye from Florida. He's coming back. But look what he found.
Yeah, there we are. Well,
what does Teresa think about that, huh?
Teresa thought it'd be smaller. Yeah. So we have the EI team out at the airport now for the next 24 months.
I think that's a good-looking crew there, Mike.
I think it's a snappy picture.
And I like what it says: the greatest chance of achieving your financial and life goals. Right.
Well, and hopefully over time we're going to get. There's so much more we got to talk about in this show yet. Once we get beyond inflation, and a lot of topics to cover yet. And I really hope people find it helpful. I mean, they can sift and choose what they want to hear and what they don't want to hear, and we're having a blast doing it. So what the heck?
We have fun here, folks. Yeah. Watch out for the trafficker cookies on the way in.
Right.
So anyways, again, let's talk about inflation a little bit. And, that's all the rage. We were talking about Mike's got a nice Ford Mustang, and he's like, I'm glad I bought it like when I did a couple years ago, because if I bought it now, it'd be much higher. And I think we all heard the stories now. Whether it's Ameren, whether it's Ford Corporation saying to their dealers, if you sell a car below sticker price, we will fine you, right? Like
above.
I'm sorry.
Above, yes.
And, from Walt Disney, Enphase Energy, PepsiCo is going up 10%.
Well, food, just go in the grocery store, everybody sees it.
Yeah. And so I guess what I want to share with you is that...
Well, and I will say this. I posted this as kind of a joke about on my Facebook page, but I filled up the other day. It cost me $473. What's this talk about inflation? Oh,
yes. So here, what is the data showing us, right? What is the data showing us, right?
Yeah.
Hotter than anticipated, but... We're up at that 7.5 year over year, but I think we might have seen the last of the 0.9s. This slide here shows that we're not necessarily super inflecting down, but I hope that we're getting there. But I will say, like, if you look at January 2021, actually that should be January 2022. No, 2021 in February. Those are small numbers like 0.2 and 0.4. look for like inflation to kind of stay elevated because we're going to replace those January and February bars with higher numbers moving forward. Does that make sense? So we're not going to go above 10%, but we're going to be here in this range that doesn't make us feel comfortable.
Well, I sent you something too. I don't recall exactly, but didn't it say the last time we had inflation like this, the Fed fund rate was 11% or 8 or something?
Yes, think about
so
this.
The Fed's still way behind the curve here.
Let's talk about that. So, like,
Okay.
Mike,
Let's talk about that.
because 19 is 40 years ago, right? 1982 was the last time we had this high of inflation, and 11.5% Fed funds rate. So where are we now, folks? The Fed is still
Low.
We're still low. And I think I have here on the slide here, there's two fundamental mistakes the Federal Reserve has made. And I've historically been a big fan of the Fed, especially with Greenspan, Volcker, some of those classic economists. Number one is they got the whole transitory narrative wrong. They kind of put that to rest in November of last year. And the second thing is that they've kind of created some uncertainty with regards to inflation expectations, right? Like they're behind the curve, as you said. So people are worried that they'll overdo it now. Like they're so far behind, we shouldn't be at 11.5%, but we should be higher than zero. And in fact, we're in the month of February. They're still expanding the money supply.
Well, enough they probably have to jump it up quicker, right?
Yeah, so that's the
pops.
question, right?
Yeah,
and that's sort of the thing. And so right now, like, what's going to happen here in the next few months? The St. Louis Federal Reserve President James Bullard came out yesterday and really tanked the market. The reason the market was down yesterday is all about uncertainty. One Fed official came out and said, we're going to have to move quickly. We are looking for maybe a 1% Fed fund rate by July 1st. And so now the market is kind of absorbing these additional increases at quicker paces than they were before.
Did you read the article I sent you on Vanguard saying maybe 3?
Yeah.
Target.
Yep.
Yeah.
That's substantial. And I want to let everyone know, like, we can't get up to 11.5% interest rates because the Fed's boxed in that corner because the debt is too high. And folks, that's some little bad news, but national debt went above 30 trillion. So if you for every 1% you raise interest rates, folks, that's $300 billion per year.
A debt service.
So if you go 2%, that's $600 billion. 3%, $900 billion. So just think about that they're boxed into a corner. The estimates from the Chicago Mercantile Exchange, here's a graph here. Interest rates are going to go up kind of fast. My feeling is I'm kind of a traditionalist, thinking the Fed will take like a slow quarter basis points approach, Mike, but they could maybe do, like, just to get it started, like a 50 basis point spike in March. March 15th is the first date. But they're looking at something like 2% by the end of the year. Go ahead.
My personal take,
Yeah.
because I'm not an economist or a PhD,
Yeah.
but rates are so low that making a big deal out of a 50 basis point Fed funds rate, in my book, is nothing. Rates are so low; they're artificially. We've been low since 08, 09. We had the first mortgage crisis, and we had to start dropping rates.
Yeah.
And when we should be back up to where you can easily get a short-term ladder and at least get 4% on fixed income.
Yep.
Mike Mahoney take.
Yep. Right.
We'll see.
And Mike, you always talk about the effects of people from the mainline press, the mainstream press.
Right.
Well, once that announcement came out, like from Josh Bullard, The Economist, the famous magazine, came out, and this is one of these scary covers they put on. I guess fear sells, right, Mike?
Sure. Bad news.
Yeah, bad news. Are we headed into a recession? So my last thing I want to talk about is the United States, are we heading toward the brink of like this roller coaster that you just saw from The Economist? And the answer is quite likely no. There's just a lot of those indicators, economic indicators that I rely on. There could be a black swan event, but one of my favorite is the yield curve. And I have a slide up here on the yield curve. You can see that there is some flattening of the yield curve on the 2-year to 10-year levels, But overall, the 3-month is still pretty low. So if you look at that, that's a nice upward sloping yield curve, although there are some flattening in the longer run. So what that means is, it means this: things are okay. It means that short run risks are less than long run risks. And that makes sense, right? That makes sense. So maybe the next 6 months or so, people can kind of put their recession fears to rest. It doesn't feel good if you're on a fixed income and you're on Social Security and inflation 7.5%. You might say, this doesn't feel good. Something's wrong. The country's on the wrong track. But overall, I don't think we're going to head toward a recession necessarily. And how about people's portfolios, Mike? What have we learned over like decades and decades of equity returns? How does the market fare during times of changing prices?
Over the long haul, you still do fine, but I mean, you're going to get some volatility. It's going to occur if we start to see a lot of interest rates. But I want to add this. I mean, even if we do enter into a recession, I mean, you're still going to want to keep your portfolio if you're well diversified and not panic or sell. I mean, I think that's the problem with a lot of this news media and everything else, and the prognostication is that can sometimes force people to take action when they really shouldn't take action.
Right. And I think one of the things this is a really great takeaway for everybody, but most people, they've never went through a formalized process where they've stress tested their portfolio. And so what we can do for you here, just go to enlightened-investor.com. Our contact information is there, a lot of free information. If you go to our site, we can put together really quickly a stress test for you where we do a lot of simulations, right, Mike? And
yeah, well, it's more of your portfolio. You're stress testing your portfolio built into your plan, right? Just make sure that you're not taking too much risk to achieve your goals.
Exactly. And so I'm hoping that maybe people that are have a stress-tested plan can sleep better at night.
Sure.
During these crazy times when your Ameren, Illinois heating bill's up 90%.
Yeah, right.
So what do you think, buddy? Any last words for
inflation 3.0? I'm good.
So we might take a little break on inflation, but thanks for being here, folks, and you guys take care.
Bye.
Bye-bye.